Hi everyone, thank you for attending our webinar today on why the 60-40 retirement strategy doesn't really work in a low yield environment and how financial advisors can really focus on implementing better retirement strategies to attract and retain high net worth clients. My name is Rajiv Rebello. I'm the Principal and Chief Actuary of Colva Actuarial Services. We're the math advisors to financial advisors, and we're really going to show you here in this webinar on how to implement better after-tax, after-advisory fee retirement solutions for your clients to help you grow your business and implement better strategies. So I won't spend too much time talking about my background, but we're essentially an actuarial firm that helps improve after-tax, after-advisory fee returns for RIAs and family offices by just focusing on implementing more tax-efficient solutions. So let's go ahead and just jump right into it. Why does the 60-40 retirement strategy no longer work in today's current low-yield environment? Well, the first issue, right, is that current bond yields are at historic lows. And the problem with this is that as you're nearing retirement, you're allocating a larger percentage of your client's portfolio to bonds. So when bond yields are at historic lows, they're no longer providing the gross yield necessary to offset the equity risk and provide diversification, right? So that's the first issue, is that current bond yields are at historic lows. The second is that bond gains are highly taxable, right? So if you're a high net worth client living in a state with a high income tax, a large portion of those gains, which are already low to begin with given the low yield environment, they're losing to taxes. On top of that, if those bonds are in a taxable account and you as the RIA are charging your AUM fee on an after-tax basis, the clients are getting really nothing out of that bond portion of the portfolio. And we'll go over the math in a second here. And finally, the last 2 points are that in this current low yield environment, when interest rates do rise, clients will absorb heavy losses to their bond portfolio depending on how long the term of the bonds they're invested in. And we'll talk about that in a second. And finally, typical strategies like asset location, which can kind of help high net worth clients deal with some of these problems in a higher yield environment, don't really work in the low yield environment. On top of that, these high net worth clients are phased out of contributing to traditional tax advantage retirement plans like the traditional or Roth IRAs that could help them with this issue, right? So these are all the reasons why the 60-40 retirement strategy no longer works in this current low yield environment. So again, bond portfolios in a low yield environment pose more risk than diversification benefits, and we need better strategies to attract and retain high net worth clients. And that's what we'll be talking about later on in this presentation, or what are the better retirement strategies that you can implement to actually help your clients meet their goals in today's new low yield environment. So now let's kind of talk about why kind of paying an AUM fee on a low yielding taxable bond doesn't really make sense for high net worth clients. We'll just briefly go through the quick math here. So again, as we talked about, as clients near retirement, advisors typically choose to allocate a larger portion, up to 40% of clients to a short-term bond portfolio like the AG, simply to avoid interest rate risk, right? You want to avoid sequence of return risk, and that's why advisors are typically doing a higher bond portfolio allocation as they near retirement. But obviously, in today's low yield environment, this isn't really providing the diversification benefits that it used to in a higher yield environment. And so let's just go on over the math real quick. Again, the gross return on the bonds we're just going to assume is 2%. In reality, right now, the gross returns on bond benchmarks like the AG are significantly lower than 2%. They're closer to 1%. But let's just use 2% as a math example to make some of the math here easy. The tax rate, let's assume it's 50%. Let's a high net worth client living in California or New York, and then the advisory fee is 1%. So let's walk through the math of what they're actually getting, right, for choosing to invest in bonds and walking away with. So again, on an after-tax basis, they're getting, here's the gross yield, and they're losing 50% of that to taxes. So now they have the 1%, right? But then they're paying the advisory fee of, let's assume that's 1% for simplicity's sake. So again, on an after-tax, after-advisory fee basis, they're making nothing because the after-tax return of 1% is being reduced by the 1% AUM fee that the advisor is charging, right? So they're walking away with nothing, even though they're taking all the risk, right? They're taking the credit risk, they're taking the liquidity risk. So this is the issue with kind of the bond portfolio, or the increasing bond allocation in today's environment, is that they're essentially getting nothing and taking all the risk. So the last thing I want to talk about with this is, again, the ag is significantly less than 2% right now. So what's going to happen, right? What's going to happen in today's low yield environment, and why is this an issue that RIAs really need to focus on addressing? It's because eventually they're going to do the math, right? They're going to do the math, and they're realizing that if you're a high net worth client, you're losing just too much of your net return to the advisor on the bond portfolios, and it doesn't really make sense anymore for clients to give, or high net worth clients to give the bond portfolio of their allocation, or the bond allocation, or the portfolio rather, to RIAs, because it just doesn't make sense on an after-tax, after-advisory fee basis. So let's kind of just look at some of the assumptions here and why that no longer makes sense. On the equity portfolio, it still can make sense. Again, let's assume it's a 60-40 portfolio, so 60% are in equities. We're going to assume the gross return is at 8%. Again, the historical return has been a little bit higher than that, about 10%, but we'll use 8% for this example. Again, the marginal tax rate is 37%. The RIA's after-tax advisory fee is 0.75%. So I'll skip the math here and just jump to the end. The after-tax, after-advisory fee return is 4.29%, right? So if we actually look at, well, what percent of this net return did the client lose to the advisor? On the equity part of the portfolio, it's not bad. It's about 17%. However, when we look at the bond portfolio, it's a completely different situation, right? Again, we're going to assume 2% is the gross yield on bonds, 50% the marginal tax rate. We'll use a lower 0.75% after-tax advisory fee. But what happens even using this is that on an after-tax, after-advisory fee basis, right, the client is only getting 25 basis points, but the advisor is getting 75 basis points. So the advisor is actually making 3 times what the client is making. For taking all the risk. So as we said, high net worth clients will eventually realize that this math doesn't really make sense, right? The advisor is getting 300% just for managing the assets than they are for taking all the risk, right? So what is the point? Again, high net worth clients will eventually realize that it's better just to leave the equity portfolio with the RIA. That way they get all the financial advice that they need. But they can invest the bond portfolio, 40% of their assets, right, into a low-cost bond index fund themselves. So they're either going to do this, they're going to take the bond portfolio away from RIAs, which means that, again, you're losing 40% of your AUM, or they're going to take the entire portfolio to an RIA that implements better tax-efficient, fee-efficient solutions for them. And that's what we're here today to help you out with, is how do we create those better solutions? What are those solutions, and how can we help you implement them into your practice to both retain your current clients, but also use this as a way to market better tax-efficient solutions to high net worth clients who are not getting this at their current financial advisor, or don't realize that important tax planning is really a crucial part of financial planning in today's low-yield environment. So again, what all advisors are probably familiar with are doing Monte Carlo simulations. So we can actually do the simulation at different equity bond portfolio compositions and see, well, what has the better chance of meeting a retirement goal. So we'll assume that the retirement goal is 4% of their assets. The client wants to take out 4% of their assets at different equity bond portfolio allocations. So which is better? Should they go 100% equity? Should they do the 60-40? And we'll actually see that when you do your simulations on an after-tax, after-advisory fee basis, they're actually better off investing in a 100% equity portfolio than doing the 60-40, right? So even the 100% equity portfolio only gives them a 42% chance of meeting this 4% retirement goal in today's low-yield environment. But the 60-40 is at half of that. They only have a 21% chance of meeting their retirement goal. So there is really no value in a low-yield environment of clients using bonds as a diversification method, right? Because on top of this, the yield is too low. They're paying too much in taxes. And what's not even being included here is that if interest rates rise in the future in 5 to 10 years, these bonds that they're invested in today will take losses, right? So it's a serious issue that financial planners need to keep in mind. And the high-level point here is that in a good economy, you can just focus on asset management. It's okay. You can stick your client in the 60-40. You manage the client relationship. You don't have to be as concerned with the downside risk here, because The equity returns are doing fine. The bond yields are significantly higher, so providing better diversification against your equity risk. So just the asset management approach is fine. However, in the bad economy or a volatile economy, you need better financial planning tools at your disposal because clients become overly concerned about risk and they want strong financial planning as they near retirement. Because bond yields are low, they need better financial planning solutions. So now is really the time for strong fiduciary financial planners to demonstrate their value add in a volatile, low yield environment. And that's what we're here again to help you out with today on this webinar. So here's the crux of it. Well, what are low yield taxable bond portfolio solutions? What can I be doing to help my clients get a better chance of meeting their retirement goals? So there's a number of solutions that can be implemented here. Obviously, we talked about, or we will talk about later, asset location, which is essentially just minimizing the taxes due on these assets, and we can do that by putting equities and bonds into the structure that minimizes the taxes on them. So that really means for the large part is putting tax efficient equities and taxable accounts and using tax advantage retirement accounts for bonds and tax inefficient strategies, equity strategies rather. Obviously, backdoor Roth IRA conversions, right? If you're self-employed, you can dump large amounts into a self-employed tax-deferred IRA or 401k plan and then convert it to a Roth IRA. It's really just a play on what the taxes are going to be in the future, right? So if that tax-free growth is worth it to you, the tax-deferred growth, again, depending on what your client's tax brackets will be in retirement, these are great strategies as part of your financial planning solutions for them. Obviously, tax deferral, right? You want to defer gains on your bonds until retirement, when hopefully your client can be in a lower tax bracket, and then take out those gains on their bonds while they're in a lower tax bracket, obviously before their required minimum distributions and Social Security kind of kick in. We talked about using retirement accounts to charge an AUM fee pre-tax instead of after-tax, right? So the great thing about IRAs is, if you're a financial advisor charging an AUM fee, is that you can use these retirement accounts to charge your AUM fee pre-tax instead of after-tax, which of course will reduce the taxable yield to the client and create greater after-tax returns for them. So again, another reason why you want to put tax inefficient bonds into retirement accounts is because you're also reducing the tax liability on those bonds. Again, another solution we can implement here are no commission annuities. And what people don't realize, and financial advisors don't realize, is that no commission annuities are just really investing in long-term bonds without interest rate risk, while still allowing you the ability to charge your AUM fee pre-tax. So all it is essentially is a retirement vehicle similar to your IRAs that gets tax-deferred treatment, but which have no contribution limits. Or the contribution limits rather aren't as low as your traditional IRA contributions, and we'll see that later on in some of the following slides. Another strategy we'll talk about is guaranteed lifetime income, right? In a low bond yield environment, clients can actually profit if they have a long lifespan and they keep the policy, right? Part of the reason guaranteed lifetime income works is because a large portion will cancel the policy early and then are at a deficit. But if you keep the policy, and also obviously if you have a long lifespan, which higher net worth clients typically tend to have because they're living longer, have better access to healthcare, this really can make a lot of sense, right? Especially if they're not looking to pass on wealth in their retirement and want to spend and enjoy their retirement instead. We'll also talk about alternative investments, right? Bonds used to provide diversification in a higher yield environment to equity risk. When yields are low in this environment and subject to interest rate credit risk, in the future, using uncorrelated assets with higher return profiles can provide better diversification than low yielding bonds with interest rate risk. We'll also be talking about private placement and low commission life insurance, right? How can we use the tax code to rip out expenses and use life insurance as a financial planning tool, a retirement strategy to take principals and gains out tax-free? Okay, it's a strategy to improve after-tax returns, similarly to how you're using traditional retirement strategies like IRA accounts and Roth IRAs. So we'll really show you how you can use low commission life insurance and private placement as a financial planning tool if you understand the risk return reward scenario here and how to use it. So now let's talk about asset location, which really is just if we simplify the term, is just all it is matching equity and bond portfolios with the tax optimal structure that minimizes the taxes due on these assets. So let's look at just a flow chart and quickly go over the benefits. And all asset location really is putting tax efficient equities into taxable accounts and bonds and tax inefficient equities into retirement accounts like your IRAs or 401k, etc. And you might say, well, what is the benefit of doing this? And the reason why you want to do this is because long-term equity gains, right, in taxable accounts, so tax-efficient equities, get beneficial tax-deferred treatment and lower capital gains treatment. So at the top rate for high net worth clients, that's 23.8% on a long-term capital gains, right? However, long-term equity gains in retirement accounts get significantly higher ordinary income tax rates. So in other words, if you take your equity, your long-term equity gains here in a taxable account and move it over to a retirement account, if you're investing in long-term equities and then you do a withdrawal, you're not going to get the low 23.8% tax bracket. You're going to get the 40.8% top federal bracket on federal ordinary income taxes. So that's why you really want to put tax efficient equities into taxable accounts, because you get the lower capital gains treatment. However, bonds and tax inefficient equities, you really want to focus on putting those in the retirement accounts because you get the benefit of tax deferral for one. And those gains are already taxed at ordinary income rates. So if you were to invest in bonds and tax inefficient equities within taxable accounts, you'd essentially be getting taxed at short-term ordinary income anyways. So investing here, these bonds and tax inefficient equities in the taxable accounts means you're getting ordinary income anyways. The benefit here of the retirement account is that you get to defer those taxes. And we'll talk about later why tax deferral is so important, is because these if you're a high net worth client, or you're advising a high net worth client and they're in a high tax bracket when they're working, if you're able to defer taxes on these tax inefficient assets like bonds or short-term capital gain equity strategies, what you can do is defer those taxes till they're in retirement, so you get the benefit of compound interest without the tax drag, and then you can withdraw that money at a lower tax rate. So retirement accounts have multiple benefits, right? Again, the tax deferral, the ability to minimize taxes. The other benefit that we should mention is that if assets are in the retirement accounts, you can charge your RIA fee pre-tax instead of after-tax, which again further reduces the tax liability for clients. And that's why retirement accounts, tax deferral can be so important for your high net worth clients who are in high tax brackets. So again, why you want to use asset location, because you want to minimize the taxes due on your client's portfolio, and especially in a low yield environment, minimizing taxes really means additional return for them without taking additional risk, simply by using the tax code to their benefit. So let's go over a math example. I like to try to keep these simple, just so everyone can follow. But let's go over why are after-tax fees a problem for low-yield taxable bonds. So again, let's just use some examples. The bond benchmark yield is at 2%. Again, in reality, it's much lower than this. The intermediate bond indices like the AG, are significantly lower than 2%, closer to 1%. Again, but we're using 2% just to simplify the example. Again, we're assuming we're managing a high net worth client. Their marginal tax rate is at 50%, so they're in a high or a state with high income tax as well. The RIA fee is 1%, just to make things simple. So let's again just quickly go through the math. Again, here we're assuming the RIA is charging their fee after tax, and here we're assuming the RIA is able to charge their fee pre-tax by moving their assets into a retirement account. So let's look at the math here. Gross yield is 2%. There's no pre-tax fee if you're charging it after tax, so that pre-tax fee is 0%. So the taxable yield is just your gross yield minus the pre-tax fee, so it's still 2% in this case. Now this 2% is a full taxable yield, so you have to pay taxes on that. Again, 50% of the 2% is 1%. So what they're left with, the client on an after-tax basis, before they pay the fee, is 1%, right? They've lost 50% to taxes. Now they're paying the RIA fee with after-tax money. So they're taking that 1% net return that they just got, they're subtracting the 1% RIA fee, and they're walking away with nothing, right? So they're investing at bonds at 2%, and the client is walking away with nothing because they're losing everything to taxes and the RIA fee. Well, what happens if the RIA is able to move these, tax inefficient assets into a retirement account and charge their fee pre-tax? Let's go through that example. So again, the gross yield is the same as it was before, 2%, but only difference is here you're able to charge your pre-tax fee. So that pre-tax fee of 1% reduces the taxable yield. So the taxable yield is no longer 2%. The taxable yield is 1%, significantly lower. And because the yield is lower, that means the taxes paid on the yield are lower. So the taxes here are 0.5% as opposed to the 1% when you charge your fee on an after-tax basis. So we've reduced the taxable yield, which means we've reduced the taxes. So the after-tax yield is 0.5%. And again, we've already paid the RIA fee, so there is no after-tax fee here. And so simply by moving tax inefficient assets to a retirement account where you can charge your fee pre-tax, you're improving clients' after-tax after fee return by essentially 50% of whatever you're charging. So simply by moving assets into a better structure, you're able to provide the clients with better yield. And this is a great way to kind of counter some of the low yield environment that we're in, or your clients are in rather, and help them better achieve their retirement goals simply through better tax planning. So now let's talk about, well, why is tax deferral of bond gains, why is tax deferral of bond gains so valuable in retirement, right? So here what we have is the age of the client as they're getting older, and then we have the presumed tax rate. Now the issue is when your client is working, they're in a high tax bracket, right? So let's assume they're a very well-to-do doctor or lawyer or entrepreneur, and they're working. They're in a high tax bracket. But if you've done optimal planning and used asset location, right, what happens is that when they retire, they're no longer getting that W-2 income. So their tax bracket, again, all their assets are either, again, long-term capital gains, which only get taxed when they realize it, or in retirement accounts where you can defer the taxes. So you're going to see a sharp drop-off with optimal planning in their tax rate in retirement. Obviously, as they start making withdrawals, that tax rate will go up, but there is a window to minimize taxes that otherwise would have been highly taxed if they would have withdrawn that while they were working. So by using optimal planning, what you can do is essentially defer taxes until they're in this financial planning window, again, before they start taking required minimum distributions and Social Security, which they can defer taxes and then take those gains out at a lower bracket. So you can defer bond gains during the high tax rate ordinary income working period to this kind of optimal tax window before RMDs and Social Security start. And you can kind of use this in combination with other strategies. So if the client has a second home in a no state income tax like Florida or Texas, they can kind of use this to further reduce their taxes. Again, this is why kind of a strong financial planning is important, because you can create different tax optimal solutions in a low yield environment, which again helps offset the risk that low yields propose. So kind of again, let's do a summary of putting bonds in taxable portfolio versus putting bonds in a retirement plan. We'll talk about the issues with bonds in a retirement plan. So first, let's say, can you defer taxes, bonds in a taxable portfolio? No. We talked about how you can defer the gains on taxes on bonds in a retirement plan. So that's a benefit of retirement plans. Can you charge your AUM fee pre-tax? Not if the bonds are in a taxable portfolio, but you can if those bonds are in a retirement plan. Can you dump in a large amount of assets, right? Well, you can do that if it's in a taxable portfolio, right? You can dump in a large amount of after-tax money. But if they're in a retirement plan, you're limited by contributions to that plan in a given year. So you just can't do a large dump in, obviously, unless you're doing something like a backdoor Roth strategy. But you're typically limited in your contributions each year to retirement plans. So you have to figure out ways to back into it. And we'll talk about how some life insurance annuity solutions are essentially backdoor solutions where you can dump in a large amount of assets. So that's one issue with retirement plans. Can I invest in higher yielding long-term bonds without interest rate risk? So you can't do that with bonds in a taxable portfolio. You're still subject to interest rate risk, and in the retirement portfolio as well, you're also subject to interest rate risk. So the benefits of investing in bonds in a retirement plan are really in these top two here, is that you can defer taxes and you can charge the AUM fee pre-tax, thereby reducing taxable liabilities. However, as we talked about, investing in bonds in retirement plan doesn't solve the problem of low yield, high high interest rate risk problems or credit risk. And doesn't solve the problems that high net worth clients have contribution limits, right? So they're limited in kind of moving assets over into this retirement plan where they get tax prefer or tax advantaged benefits. So let's actually look at the contribution limits. Like, why can't high net worth clients just move all their taxable bond portfolio to retirement plan? Is because there are limits, right? Ideally, you would move taxable client bond portfolios to a retirement plan, and then you'd manage the tax inefficient equities in a taxable account. But again, they're often phased out of contributing to retirement limits, and these are just the some of the limits here. For the 401k, again, assuming there's a catch-up provision, they're over 50, it's about 26k. Traditional Roth IRA is about 7,000. Again, we're not including the backdoor strategies. And then if they're self-employed, this SEP IRA, solo 401k type plans are about 63,000. Obviously, if you're a high net worth client, you're nearing retirement, and you haven't done optimal tax planning to that point, you're going to want to move a lot more of your tax inefficient assets to your retirement plan, and you won't be able to because you're limited in your ability to contribute, right? So, again, high net worth clients are limited in their ability to contribute to these tax deferred plans, which could help them in the low yield environment. So we really need to focus on retirement strategies and financial plans that help them address this. So now what I want to touch on is something we mentioned earlier, is that whether you invest in bonds in a taxable account or in a retirement account, it's not solving this, or addressing this interest rate credit risk problem, which is essentially looking at the fact that yields are at historic lows, and if interest rates rise or credit risk spreads increase, they pose significant upfront losses. So let's just take a look at the severity of those losses and why it's important to acknowledge that in your financial planning. So why is interest rate risk a problem with low yield bonds? Well, low yield bonds are subject to mean reversion. In other words, if they're low yield now relative to the historic mean, which is higher, that over time that it will revert to those long-term interest rates, right? And that could happen, if the Fed stops suppressing interest rates as they are in today's environment. The economy, fully recovers and gets on a less volatile path. And if the Fed increases interest rates to fight off inflation, again, you're posed with this problem. Another issue that could happen is that the market loses faith in issuers' ability to pay back bonds, so credit risk spreads increase. And obviously, what people might not be aware of is that low yield bonds have a higher duration, or in other words, higher sensitivity to interest rate risk, right? So again, the lower the bond yield is, the more clients will lose if interest rates rise. And we'll see that later on in a following slide. So what happens if interest rates are at 2% and just rise by 1%, right? Let's look at how sensitive low yielding bonds are to a change in interest rate, right? So let's say you invest in a bonds of various terms. There's a 10-year term bond that matures, a 20-year term bond, and a 30-year bond. Well, how much will you lose, or will clients lose, if interest rates rise by 1%, right? So they go from 2% to 3%. Well, if that happens, the immediate loss on market value of a 10-year bond will be about 8.5%. A 20-year bond is about 15%, and a 30-year bond is 20%. Again, longer-term bonds do have higher yields, but they also come with higher interest rate risk, and that's why when clients are nearing retirement, typically the bond allocation is to kind of more intermediate-term bonds as opposed to the long-term bonds, because advisors realize that long-term bonds will be subject to interest rate risk, and that same sequence of return risk that they were worried about with the equity portfolio, they'll experience in the bond portfolio if interest rates rise. So the traditional strategy of the 60-40 strategy is 40% are in bonds, but most of those are shorter term bonds. Again, which if you're going for shorter term bonds, you're not really getting much yield. So now let's look at so let's say interest rates do rise. I've allocated my clients to a bond strategy, probably, more shorter term bonds. How long will it take of investing at the higher coupon rate? Because again, if interest rates rise, it went from 2% to 3%, which means in the future, they'll be getting that 3% return, right? So how long will it take me or my client to get back this 8.5% that they lost initially, right? So it'll take them about 4 years if they're investing in mainly 10-year term bonds. If they're in 20-year term bonds, it'll take them 6 years just to get back to their original value. If they're in 30-year bonds, it'll take them 8 years to get back to just to make up what they lost on day one when interest rates rose, right? So sequence of return risk means that earning a higher yield on a lower base, right? Because you've lost this base here initially is not an equal proposition, right? So even though interest rates rise, it's going to take you a while to get back to just what they started in, just what they immediately put into those bonds. And the problem is that the entire financial planning did not assume for this reversion of interest rates back to the mean. And so if you're doing financial planning and you did your stochastic models, assuming bonds are at 2%, the whole retirement strategies are dependent on that 2% return on bond yields. But the fact is that interest rates rise. It will take you 10 years of investing in a 10-year term bond just to get back to the 2% yield that you projected, right? So that's those first 10 years, your clients are at a loss, and again, exposed to sequence of return risk. So it would take them just 10 years to get back to where they started, right? If they're in 20-year bonds, it'll take them 17. If they're in 30-year bonds, it'll take them 23 years just to get back, to the 2% yield that was projected, right? In your financial planning scenario. So in this period, right, if this were to happen, while interest rates are supposed to be low for the next 5 to 10 years, if you're allocating a large portion to bonds and then slowly interest rates are rising and reverting back to the mean over those 5 to 10 years, and then going forward, clients will absorb a heavy loss. They'll be making withdrawals at that same time, and on top of that, the client loses income, is subject to interest rate risk, sequence of return risk, and the RIA is losing AUM fees. So again, if you're in 10-year terms, for those 10 years, you had projected AUM fees assuming this 2% yield. So neither will the client be getting the return they were expecting in their original financial plan, and the RIA won't be earning their fees, right, across their entire book. So this is why interest rate risk poses a problem in a low yield environment for both clients and the RIAs that are managing that. And the 60-40 portfolio doesn't really make sense for either one. So now let's talk about how no commission annuities can solve some of the interest rate risk and low yield problems that we saw on the previous slides, right? So what a lot of financial advisors don't realize is that annuities are just investments in long-term bonds without interest rate risk, and by stripping out the commission part of these annuities, it allows the advisors to do two things: provide higher yields for their clients' bond portfolios, as well as the ability for the advisor to charge their RIA AUM fee pre-tax, just like they are on clients' retirement accounts. Again, so let's summarize the benefits of no commission annuities and how they can solve some of the problems of low yields in this environment, and a limited ability of high net worth clients to contribute to retirement plans. So again, we have bonds in our taxable portfolio, bonds in a retirement plan, and bonds in no commission annuity. So let's look at how no bonds through it in a no commission annuity can solve this problem, right? So can you defer taxes? Again, bonds in a taxable portfolio, you cannot defer taxes, whereas bonds in retirement plans or bonds in a no commission annuity, yes, you can defer the taxes here. Can you charge your AUM fee pre-tax? Not if those bonds are in a taxable account, but you can if those bonds are in retirement plans or in the no commission annuity. Can you dump in a large amount of assets all at once into either of these vehicles? Well, you can if it's in a taxable portfolio, right? There's unlimited amounts that you can kind of invest in taxable bonds. Obviously, we talked about how the retirement plan has contribution limits, so you can't do an immediate dump in, right? You have to try to find backdoor strategies here. Bonds and no commission annuity, you can dump in a large amount of assets, right? So you can dump millions of dollars here through no commission annuities. So for clients who can't figure out how to get their bonds into tax preferred vehicles, this is a great way of doing it, right? The other issue that bonds in a no commission annuity solve that bonds in a retirement plan can't solve, and neither can bonds in a taxable portfolio, is this interest rate risk, credit risk problem we were talking about, where no commission annuities allow clients the ability to invest in higher yielding long-term bonds without the interest rate risk. So no commission annuity solves the contribution limit problem of high net worth clients, as well as the interest rate / credit risk problem of retirement plans. So again, let's summarize what a no commission annuity is. All a no commission annuity is an investment in long-term bonds without interest rate risk that receives the same tax benefits of a retirement plan, except with the additional ability to contribute millions of dollars into it, whereas retirement plans have more hard contribution limits. There are no expense loads in the no commission annuity, which allows for higher gross returns for the client, and as we'll see in a second, higher after-tax returns as well. So this vehicle is really built for RIAs to earn their AUM fee pre-tax instead of charging it on an after-tax basis in a taxable account, which, as we talked about, reduces tax liability for clients and provides clients with higher after-tax returns. So RIAs can use no commission annuities as financial planning tools to more effectively help clients achieve their retirement goals through higher after-tax yields, while also providing them with additional protection against interest rate risk, which is very important in a low-yield environment. So let's look at the two main types of annuities that invest in long-term bonds, which are fixed annuities and indexed annuities. There are also no commission variable annuities, but those invest in equities, which obviously we're leaving out of the conversation here. So fixed annuities, right, are investment in long-term bonds without interest rate risk. So the trade-off here is that you're exchanging part of the yield of the long-term bond for no interest rate risk. So you could invest in long-term bonds, or the client could invest in long-term bonds directly through a taxable account or in a retirement plan, but they would get no protection of interest rate risk, right? So they would get higher yields than they would through the fixed annuity, but they'd be taking the full interest rate risk, such that when interest rates rise, clients would be absorbed with a loss. So in order for a protection against that loss, they're accepting a lower yield of the fixed annuity, right? But again, the fixed annuity will be higher than intermediate bond indexes like the AG, right? So it's a great way to provide stable fixed income and, like we talked about, greater after-tax returns on bonds, right? So for clients who want more yield, right, than just a straight long-term bonds, the ability is there for them to invest in what's called an indexed annuity, which is still primarily a long-term bond investment without the interest rate risk, but it's also a part investment in an index that provides a floor against losses and a cap on the gains. So what this does is it provides them with additional yield, right? So similar to the fixed annuity, you're exchanging part of the yield of long-term bonds for no interest rate risk, but the benefit that comes here is that you have the ability to participate in equity markets that have a higher gross return, right? So it's protecting them against losses. So if that equity index, absorbs a loss, a negative 10% or 20% in a given year, it's providing them protection. So the client absorbs no loss. In exchange for not absorbing a loss when the index does really well, there's a cap on the gains. So this structure here allows for the same protection you get in the fixed annuity, but with the ability to participate in an equity index that is making higher returns. So again, the returns on an indexed annuity will be higher than a fixed annuity, but will obviously be more volatile because the fixed is just a straight yield that they're providing. However, you'll find that indexed annuities in a low yield environment will be less volatile than the underlying bonds, right? Because there's no interest rate risk. So if the choice is between risk and return, you can choose here. Is that the fixed annuity will be lower return, but also less volatility. The indexed annuity will have higher returns than the fixed annuity, but be more volatile than the fixed annuity. But again, either comparable volatility with the underlying bonds or less volatility. So let's look again at the historical returns of both bonds and no commission annuities. So here we have two standard bond indices, the AG, which is an intermediate term bond, and the IGLB, which is a long-term bond index. So we can also see the returns, the compound annual pre-tax returns from 2016 to 2019, as well as their annual volatility. So the AG from 2016 to 2019 returned about 3.5% compounded during these years. The volatility on that same index was about 3.28%. The IGLB, on the other hand, was about 7.62%, the compound annual return. So significantly higher, but also it's a long-term bond, right? So as we talked about, it has higher yields than the intermediate term bond. But the volatility is also higher, right? So the volatility of the IGLB over that same period was about 8.18%. Well, how do these two indices compare to no commission annuities, no commission fixed and indexed annuities, right? So let's look at that. So the no commission fixed annuity over this period, and this is just from one company, but gives you an example of how fixed annuities and indexed annuities compare to the underlying bonds. So the no commission fixed annuity was 3.30%, so a little less than the AG, and significantly less than the long-term bond yield. But again, part of this bond yield was from interest rates declining, right? So capital appreciation. So The no commission fixed annuity, again, was a little bit less, but the volatility, extremely low volatility, because they're essentially giving you a fixed rate of return, right? So lower yield than the long-term bond. In this case, it was lower yield than the ag, but again, significantly lower volatility. The indexed annuity, however, did really well. And we can see the reason why it did well is because, again, you had a very good bull run during this period on an equity index. And this was just the index, the S&P 500. You can choose different indices within a no commission annuity. But the indexed annuity had significantly higher returns, whereas it had similar volatility to the ag, right? So the indexed annuity provided higher returns and similar volatility. So that's why these fixed and indexed annuities can provide great bond vehicles for the bond part of your investment. So again, most RIAs would not invest a large portion of a client's bond funds into a long-term bond fund as they're nearing retirement, because they don't want the interest rate risk. They don't want this volatility. But the indexed annuity allows the client to see reduced volatility compared to the long-term bond funds, while also achieving higher returns than the shorter term ag. And again, keep in mind, like we talked about, the higher yields here of the long-term bond really came from capital appreciation. As interest rates were declining, long-term bond capital appreciation was going up, right? So that's where the additional yield came from. Obviously, we're in a low yield environment, right? Historically low. So interest rates will be going the opposite direction, in which case you'll absorb losses. So again, a little bit different historical context versus going forward, but it does allow us to compare, and we can see that the volatility of the long-term bond funds versus the shorter ag, as well as the volatility of the fixed annuity versus the indexed annuity and the return. So this is why you can use these vehicles, the fixed annuity and the indexed annuity, as a way to invest in bonds with you're going to get either higher returns with the indexed annuity, or you're going to get reduced volatility. So depending on what the client needs, their risk profile, and how this fits into their modeling, you can figure out how to best invest in bonds by using these vehicles. And again, this is just the gross yield. This isn't even accounting for the tax benefits, right, that we mentioned earlier. So again, no commission annuities offer either higher yields or lower volatility than current bond allocations, if used properly. So let's look at current yields in today's environment. We can see that as of September 7th, 2020, the current pre-tax yield to maturity is about 1.13%. That's an effective duration of 7.92. So in other words, if interest rates rise by 1%, this ag will absorb a 7.92% loss. On the IGLB, again, the returns are higher, right? But again, look at the interest rate risk, the duration. So if yields rise by 1%, clients will lose about 14% if they're invested in this IGLB. And that's why, again, RIAs will typically avoid it as clients are nearing retirement. The current fixed annuity and indexed annuity, again, from the same company here, you can see that the fixed annuity is obviously less than the long-term bond, which is what we'd expect, the yield to maturity, pre-tax yield. But it is significantly higher than the ag, right? The significantly higher benefit here that is being provided. The duration we can't obviously measure because we can't see how it's being affected, especially since the volatility is lower. And the no commission indexed annuity, again, if you simulate it, right, again, you get a floor and you get a cap. And if you simulate those results in your Monte Carlo, you'll see that the gross yields are about 3.8%. So you're actually achieving a higher yield than the long-term bond index, which without as much volatility as we showed previously. So again, just to summarize, no commission annuities can offer either higher yields or lower volatility than current bond allocations, right? And so just this is as you're creating kind of scenarios or portfolio allocations for your clients, this is how you can use these tools to provide either higher yields or lower volatility. So I actually did this analysis, right, with Monte Carlo simulations. I compared a no commission indexed annuity with just investing in long-term bonds in a taxable account, and in this solution we found that by doing the Monte Carlo results, and you can again do this in your own models if it's flexible enough to do so, the no commission indexed annuity outperformed the underlying long-term bond index on an after-tax, after advisory fee basis in 83% of the scenarios, right? So you can read that white paper, which is called Investing in Long-Term Bonds Without Interest Rate Risk, the no commission annuity solution to improving after-tax, after-advisory fee bond returns. That's provided on Colva's website. You can research that and essentially see how we did that and the benefits, again, of using no commission annuities in general for clients' bond allocations. So now let's go ahead and talk about how can using no commission annuities actually help to increase AUM for RIAs through the acquisition of untapped markets. And this is a whole area that RIAs really aren't considering. And the fact is that clients and investors are increasingly wanting these products. They want fixed and indexed annuity sales because investors who are worried about market corrections and low bond yields are turning to fixed and indexed annuities. From 2012 to 2019, we saw a huge uptick in the amount of fixed and indexed annuity sales. In 2019, in fact, $200 billion in annuities and another $140 billion in life insurance was sold. And most of these were by high commissioned agents. So what does this mean? If these products are being sold by high commissioned agents, that means the expenses in these products are really high and they're not always in the best interest of the clients. So there's a huge opportunity for RIAs to realize, like, look, clients actually want these products and they can deliver, tax deferred gains or tax free gains in the case of life insurance. And if RIAs really understood how to use these products as financial planning tools and understanding that bad products are sold because of the commission and nature and the conflict of interest, but at its core, these products can be used as financial planning tools, RIAs could capture a huge segment of this market because most of this $200 billion in fixed and indexed annuity sales in 2019 were the high commission ones. Most of the $140 billion in life insurance being sold are the high commissioned ones. So if RIAs started to use the no commission version and then again charging their fee on the assets instead of an upfront commission, they're essentially getting a trail, right? The same way they're doing with their business model is you build up a huge base and you charge a fee on it. This is a great opportunity for RIAs to increase their business, to penetrate this channel, capture market share, and essentially, utilize more sophisticated financial planning tools in order to grow their existing business. The issue is that a lot of RIAs are not comfortable with insurance, right? A lot of these products have historically been not in the best interest of clients, and many clients have had bad experiences, and probably almost every RIA has had a client who's been sold a bad product and then been tasked with the job of trying to get them out of it. But the industry is shifting, and this is a great opportunity for RIAs to understand, look, in this low yield environment, insurance products, particularly the no commission ones, can provide better yields simply because of the structure. So now let's talk about another area which can help improve after-tax, after-advisory fee returns or bond returns, right? Another area is called what's known as guaranteed lifetime income. So guaranteed lifetime income is where the insurance company provides guaranteed lifetime income for the clients, and it's same thing. It's backed by the company's long-term bonds in exchange for taking mortality risk of the insured, right? So the insurance company is again investing in long-term bonds, but if the client dies, they lose their initial deposit that they gave to the insurance company. But if they live a long time and longer than their actuarial projection, then the insurance company has to keep on paying for the remainder of their life. So the insurance company is essentially using a diversified pool of lives to essentially make a bet that they understand mortality and that some people will die beforehand, some people will live longer, as well as some people will cancel the policy, thereby benefiting the insurance company. The point being is that clients in this existing low yield environment can really benefit from guaranteed lifetime income because the structure is based on bond yields, which are low, mortality, and lapsation. The clients who are lapsing the policy essentially benefit those who are keeping it, right? So guaranteed lifetime incomes are significantly higher than bond yields because, again, if the client dies, they don't get their return of principal back, right? So there's an opportunity to get higher yields. So if you're dealing with high net worth clients, who are in good health, who have preferential access to healthcare, this is a great opportunity for them to increase their yields for their retirement, specifically those who may not wish to give the bulk of their wealth to their beneficiaries after they pass away. So In a low yield environment, the mortality opportunities here and policy owner cancellation has a bigger effect on pricing than the bond yield. So clients who are in good health and who are going to keep the policy can really benefit at the expense of those who are in poorer health or who will cancel the policy. And again, higher net worth clients can use this as a financial planning tool to increase their yields that they want to spend in retirement. And the great thing about it is, in this environment, as new products are coming on the market, there are essentially indexed annuities with lifetime guarantee riders, so you don't necessarily have to give up the principal if you decide you want to exit it. So it's a great opportunity to look at the bond part of the portfolio and realize, look, with low yields, there's an opportunity for high net worth clients who are in good health to benefit from this and essentially profit at the expense of the life insurance company. So again, just to conclude, policy owners who are in great health and keep the policy will benefit at the expense of those who die early or cancel the policy. Again, high net worth clients typically live longer than people of lower income who do have less access to healthcare. So now let's go ahead and talk about alternative assets and how they can provide higher yields and better portfolio diversification through the use of low and uncorrelated assets in comparison to bonds in this low yield environment. So what do we really mean when we talk about alternative assets? So, well, alternative assets are basically non-traditional investments. So not stocks, not bonds. And when we talk about alternative assets, we're talking about, hedge funds, private equity, real estate, life settlements, which is a key area that my firm deals in, and other, non-stock, non-bond types of assets. So let's just break down the pros and cons real quick, and before we get into the next section. Well, the benefits of alternatives, like we talked about, is in comparison to the bonds in this environment, is that they can provide higher returns, right? So you're getting a higher return, and often a higher risk-adjusted return than bonds. Again, you can get a better portfolio diversification, especially if it's uncorrelated to the market, which means, if the stock markets go down, your alternative asset, the value of your alternative assets aren't also going down. Same thing with interest rates, right? If interest rates go up, you're not necessarily seeing a drop or a markup in the valuation of your alternative asset. And that's why they can be a great tool in providing a portfolio diversification, just like how bonds used to play in a higher yield environment. So now let's go ahead and take a look at the disadvantages of alternatives, right? Well, for a lot of alternative assets, you need to really be an accredited investor, and those often come with high investment minimums. So they can be as high as $250K, $500K, or more, right? Depending on the fund, the structure, the portfolio manager, etc. Obviously now with the rise of interval funds are making alternative investments a little bit more accessible through lower minimums. But primarily, a lot of alternative assets are only available to accredited investors with those high minimums. So the other issue with alternative assets is they can be illiquid, right? So they typically require a longer investment horizon than your traditional investments, which you can enter today and then exit 5 minutes later, right? So a lot of these have a lockup period where they require you to invest your capital for 2 years or sometimes longer before you can start to pull out your principal and gains. So again, they can be illiquid and require a longer investment horizon than your traditional investments. The other issue is that they can be taxed at high ordinary income rates. So some alternative assets are tax efficient and some are not. So you really want to do due diligence on the tax efficiency of the alternative investments, right? So if they're earning a high investment return but also paying high in taxes, right, that's kind of mitigated, right? So again, you want to look at the risk of the investment as well. Some alternative assets can be riskier than traditional investments. Others can be less risky. It really depends on the asset class, as well as the investment manager who's actually managing the strategy. So they require a lot more due diligence on the asset class and the investment managers because of the relative illiquidity and kind of the specialized expertise involved in managing these assets as opposed to traditional stocks and bonds. So one alternative asset in particular I want to talk about is life settlements, because that's a key area that I have been involved in the last 12 years or so, and it's an area I'm trying to educate RIAs about as well. So investing in life settlements allows investors the ability to seek assets that are discounted at high rates and potentially achieve net returns anywhere between 7% to 15%. Again, with liquidity depending on the structure involved. So it really affords RIAs and their clients the ability to access otherwise institutional type investments, alternative assets, and provide portfolio diversification where their bond portfolios used to fulfill. Um, Again, investing in life settlements usually requires specialized actuarial and insurance expertise. So that's the the method in which they're able to provide additional risk-adjusted returns and value to their clients. And through the use of an institutional asset class, and as we'll see in the following slides, many institutional investors have invested in the space. So now let's kind of talk about the nitty-gritty, right? What is a life settlement? I've never heard about it before. Well, this is your opportunity to learn what it is and why it's an attractive asset class for a lot of institutional investors. So a life settlement is a financial transaction in which the owner of a life insurance policy sells his or her beneficiary interest in a policy to a third party for a value greater than he or she could receive from merely canceling it. So what does that mean? So a policy owner decides that they no longer need or want or can afford the policy. So they realize that a lot of policies, actually never pay a death benefit. A lot of these policies, and as an actuary has priced these life insurance policies, a lot of these are designed such that the policy owner never actually gets a death benefit, but will pay a lot of premiums in the policy and then cancel it, right? The policy owner realizes that if they cancel it, they'll get hit with surrender charges and not really receive a lot back. So they realize they actually get a lot higher payment from selling the policy on the life settlement market than they can from just canceling it. The other issue is that they can't afford or don't want to pay the expensive premiums on the policy. It just doesn't make sense anymore for them. So let's again look at the transaction process. The policy owner decides that he or she can no longer afford or no longer needs the policy, right? Perhaps the policy owner bought it when they were much younger and they had children who were young, and now they're older and their kids have grown up. They don't really need the life insurance, but they want a cash payment and want to do anything, essentially liquidate that investment and use the funds for other purposes. So essentially what they're doing is that they're selling the policy to an investor who wants to buy the policy from them in exchange for a cash payment. The life settlement buyer then takes ownership of the policy. The policy owner takes the cash and walks away, but the life settlement buyer, it has to pay the premiums to the life insurance company. So the great thing for the policy owner is they're no longer responsible for paying the premiums and they get the cash payment and get to walk away. The life settlement buyer, on the other hand, they are in fact paying the premiums, but they will get the death benefit proceeds when the policy owner or the insured on the policy dies. So you might be thinking, well, I understand why a policy owner would sell their policy. It makes sense, right? Since they can liquidate at a higher amount than they could from canceling it. But why would the investor want to purchase it? Well, oftentimes the insured is in a lot worse health now than when the policy was purchased. Especially if they were in great health, they got a policy with low premiums, but now they had some health mishaps or they've gotten older and they're in worse health. So essentially there's an opportunity, there's a mortality play here where the premiums are low relative to the underlying risk. The other reason that investors would want to purchase this life insurance policy is that they have access to actuaries or actuarial software to determine the minimum premiums to pay. Oftentimes, a policy owner of a life insurance policy is paying way more into the policy than needs to be. And the reason they're overpaying is because they don't have the expertise to kind of figure out, well, how much do I really have to pay? Can I pay less than what the insurance company wants me to? So they don't have the expertise, whereas investors, the investment community does. Again, they're treating this like an asset class because it does have asset class properties. The other thing is that the investors realize that if they select the right policies, they can provide high, stable returns, right? So they need a diversified pool. They can't just buy one policy. They have to buy a diversified pool. But essentially, it's using mortality risk. It's understanding insurance risk and how to manage that and be able to use that expertise to buy attractive policies and achieve attractive, uncorrelated returns, right? Because when people die is independent of whether the market goes up or down in a given year, right? So this is a great way to use specialized skill, which is actuarial expertise and insurance expertise to provide uncorrelated returns. So the next thing people often ask, well, who has invested in this space? Well, as we talked about, it's mainly been an institutional type asset class. So you've seen AIG, Berkshire Hathaway, Fortress, Apollo. All collectively, they've invested billions of dollars into the space. So, and the reason is because it makes mathematical sense, right? If you can get a diversified pool of policies and have the right actuarial and insurance expertise, it's a great way to achieve higher risk-adjusted returns. And that is exactly why these kind of institutional investors have invested in the space. So why should RIAs kind of be looking at this asset class in this environment, right? So what we've done here is shown kind of, the discount rates applied to life settlement cash flows versus the discount rates kind of applied to bond coupon payments. So here in blue, you have the discount rates on life settlements, and you can see it's been between 15 to 18% over the last 5 years or so, whereas bond yields have been significantly lower. So we're going to look at two types of bond yields. We're going to look at the high yield corporate debt versus the high quality. So they're kind of opposing, right? The high yield corporate debt has less quality. There's more risk involved, right? And that's why you're getting the higher yield. Whereas the high quality here in red, it's again high quality corporate debt, so backed by companies that are doing well, have a great balance sheet. So there's less risk. So obviously less risk means less yield. Again, the high yield corporate debt has more risk. So we can see the spread here between the high yield and the high quality. But the opportunity here is that the discount rates applied to life settlement cash flows are significantly higher. So there's an opportunity here for groups with the right expertise to manage this risk and essentially get a risk premium, achieve a higher risk-adjusted return relative to investors that are just investing in high yield or high corporate debt. Again, the risk premium here is that you need to have the right expertise, right, in order to realize this opportunity here. But that's essentially why institutional groups are investing in this space, because they realize even if they don't, there's an opportunity. There's such a huge spread, right? In a volatile equity and low yield environment, life settlements offer significantly higher return profile that, as we mentioned, is uncorrelated to economic conditions, right? The underlying cash flows are mortality-based and insurance-based, not dependent on market conditions. And it's essentially an institutional asset class, right, that is made available now to retail investors, family offices, RIAs, and even, again, other investors, through life settlement funds. Again, I've written a white paper on this topic. So if you wanted to learn more about the space, if you're an RIA or family office looking to provide better diversification than bonds, higher risk-adjusted returns, you can find this paper here on life settlements on the Colva Services webpage, or you're just clicking on the link. So now let's go ahead and talk about private placement life insurance. Well, what exactly is private placement life insurance? Private placement life insurance is just a financial planning tool that allows RIAs the ability to place new and existing tax inefficient strategies within a tax-free wrapper while still allowing the RIA to charge their AUM fee on the assets. So it's a win for the clients who are getting greater after-tax, after-advisory fee returns, right? And it's a win for the RIA who's able to implement better financial planning strategies for high net worth clients and show them the value of using their RIA for their financial planning. So what are some examples of tax inefficient assets that can be made tax-free through private placement life insurance? One, it are alternative assets that would otherwise be subject to ordinary income taxes. So the RIA is taking alternative assets that they already invest in or that they want to invest in, and they're placing them within this private placement structure to prevent those assets from being taxed at ordinary income taxes, and then they're now getting this tax-free return on these assets. Similar thing with equity strategies that would otherwise be subject to short-term capital gains. So again, strategies that have high turnover rates, constantly rebalancing or constantly trading, such that any gains are subject to short-term capital gains, which of course are significantly higher than long-term capital gains rates. Other tax inefficient equity strategies are equity strategies that are in fact subject to long-term capital gains rate, but for clients who live in states in which those capital gains rates are subject to high state income taxes, right? So, for example, in California, high net worth individuals, they pay a federal tax capital gains rate, but all those capital gains tax rates at the top bracket are taxed at 13.3%. So the total tax rate for long-term capital gains, for high net worth clients can be greater than 37%, right? So a lot of the gain is being lost just to taxes if you're a high net worth client in California. And again, other states that impose kind of state income taxes on long-term capital gains can make the entire equity strategy tax inefficient. So these assets, and obviously there are many more, but these are just some examples that RIAs can relate to if they're investing in any of these strategies or interested in. They can take these strategies and essentially just make them tax-free. So again, imagine the added value that RIAs can provide to their clients if they can take these great tools that they're using, alternative assets, in place of low bond yields for portfolio diversification, and then make them tax-free, right? So let's talk about private placement and the ability to invest in an asset class and then take out both the principal and a large part of the gains tax-free. So this is not something that's unique to private placement life insurance. Typical permanent life insurance allows clients the ability to invest in underlying assets and take out principal and gains tax-free. So that's just part of the tax code that allows life insurance the ability to do this, and why it's often sold this way to clients. Obviously, the issue with typical life insurance strategies is that they have such high commissions that the commissions and expenses reduce or completely negate any of the tax code benefits, such that, if you invest in a typical life insurance policy, you'd actually get hit with such high commissions, insurance charges, and expenses that you'd actually be better off investing in those strategies outside of the product than within it, right? So private placement actually makes this a tax-efficient financial planning tool as opposed to typical permanent life insurance strategies. As we talked about, the private placement life insurance rips out most of the commissions and expenses, which again makes the financial planning tool a lot more valuable, right? Once you rip out those expenses that are negating the tax benefits, while also allowing RIAs the ability to charge their fee on a pre-tax basis, right? So again, we talked about earlier how charging it on a pre-tax basis essentially reduces taxable gain for the client. In this case, the entire asset class or the entire structure means that the return is tax-free. But this is a great way for RIAs to realize, like, look, instead of investing in a taxable account, which clients again are limited in contributing to retirement accounts, this is a great way for clients to invest in alternative asset classes, get higher gross yields, and then turn those gross yields into higher after-tax returns by eliminating the tax element of it. So now let's kind of talk about the benefit here of taking a tax inefficient asset and investing it within a tax-free wrapper, right? So let's kind of just look at the before and after ability of that. So in this example, the gross return is 8%. Let's assume that this strategy is again subject to ordinary income taxes. The high net worth client marginal tax rate is at 50%, which is really high. And the RIA AUM fee is 0.75% taken after tax. So the client has a lot invested in this asset class, and then the RIA is only able to charge their fee after tax on this asset, on this alternative asset strategy, right? So again, let's just look through the math, and this is just years of investing. So again, the first year is 8%, and it's 8% in every year. Again, so what's the after-tax return? So the client's paying 50% of this in taxes, so after the 50%, they're left with 4%. Now they pay the RIA fee, they're left with 3.25% on this strategy. So what started off with a decent, but pretty high yielding return, now they're getting less than 50%, right, after all the fees and taxes are taken into account, right? So if you think about it, how do we take this strategy? We take this 8% strategy, right, and get a higher yield simply by eliminating the taxes from it, right? How can we improve returns, right? There's obviously going to be some insurance costs involved in the private placement life insurance, but as we'll see, the insurance costs are going to be significantly less than the loss to the taxes, right? So let's kind of look at the structure. Let's just look at the graph of the structure, which is private placement life insurance, which, like we talked about, allows clients to invest in otherwise tax inefficient asset, make it tax free, and then after a while, right, take out a large percent of the assets of the principal and the gains tax free. Again, in our analysis, the math is still the same. The gross return is 8%. The high net worth client marginal tax rate is at 50%. The RIA's AUM fee is 0.75% taken after tax in this example. So let's assume, like we did in the initial chart, that the RIA wants to invest in these assets on behalf of their client in a taxable account, in which case the return is 3.25%, right? 8% times 50%, they're left with 4% return minus the 0.75 we saw earlier is 3.25%. So that's what this yellow line here is here. Every year they're making 3.25%, even though the underlying asset is making 8. With the PPVUL structure, right, because there are low expenses, you can exit in the early years. But as you can see here, if you exit in the early years, here's the blue line, right, the PPVUL structure. If you exit in the early years, you're actually making less than you would if you were to invest in the taxable account, right? So if the plan is to invest in a PPVUL structure and then immediately take out the assets, you don't want to do that. You want to go straight for the taxable structure. But look what happens if we keep our money in, right? If the client keeps their money in for 10 years and then takes out their principal and large part of the gains, they're making close to a 6% return, right? The 6% after tax and after advisory fee return on the assets, right? Whereas before they were only making 3.25%. So this is why it's a great retirement vehicle for clients to invest within a tax inefficient asset and get a tax-free return within this insurance type structure. So again, the longer they keep the money in the product, the higher the returns are. So we can see in this case, if they keep it in 10 years, that they're walking away with a little under a 6% return. If they keep it in 20 years and then take out the money through a tax-free loan, they're making a little above 6% return. So there's a value added for keeping your money in, but just keeping it in as little as 10 years gets you a significantly higher return, right, than if you were to just invest in those tax inefficient assets directly. And that essentially is the entire play of private placement life insurance for ultra high net worth clients. If you do want to read more about private placement life insurance and how this can benefit your ultra high net worth clients, I again have written a white paper on this topic, which you can again find via this link at our colvaservices.com site. You can also go to the white paper section of the Colva Services website. So now let's end the presentation by talking about how RIAs can use life insurance and annuities as financial planning tools and why they should, right? And the why is ultimately that they can use specialized actuarial and insurance expertise to provide better after-tax, after-advisory fee solutions for their clients, right? And in doing so, they can market themselves as financial planning experts that can provide better yields, better retirement strategies, better retirement solutions for their clients than their competitors who are not using comprehensive tools at their disposal in this low yield environment. Because as we showed earlier in the presentation, if you're an RIA that's just simply doing a stock and bond allocation, a 60-40 strategy, that is not going to work and meet your clients' retirement goals, especially if they're high net worth clients, right? Subject to high tax rates. So the high net worth clients, which are the ideal clients for RIAs, they need better tax planning. They need better retirement solutions that really focus on minimizing taxes and increasing after-tax, after-advisory fee returns in a risk-adjusted manner. And that is exactly what life insurance and annuities can provide if utilized properly, right? If the no commission solutions are utilized properly. If the life insurance are structured such that they minimize expenses, they reduce the expenses, they reduce the commissions, then these are essentially life planning tools similar to how you use Roth IRAs and traditional IRAs to benefit clients and provide them with greater after-tax return. So that is the how and why life insurance and annuities should be used in this low-yield environment for your clients to grow your firm's a business and to acquire additional AUM by standing out from traditional RIAs that are not using these strategies. And the reason why they're not is because they don't know how. So what are the highlights of working with Colva to implement these types of solutions into your client offerings, right? And how can we help, right? How can we bridge the gap? How can we, an actuarial firm that understands these products, that have priced these products, work with you to provide better solutions, better life insurance and annuity solutions for your clients, right? So the first is that these life insurance and annuity solutions are provided at no additional cost to the RIA. So if you were to go to the carrier directly, a lot of these no commission solutions can be provided by the carrier directly. Obviously, you're not getting the structuring involved that we provide. You're not getting the consultation, the modeling, the analysis. They're just providing the solution, the product, but they're not showing you how to structure the product. How do we minimize expenses? How do we rip it? How do we structure it? How do we use it as a financial planning tool? That element is not going to be provided by the carrier, right? So you're essentially utilizing us as a way to look at the product and understand how it fits in, and you're going to get the same solution, the same product, whether you go through the carrier directly or work with us, right? So there's no additional cost. We're getting compensated by the carrier, right? So whether you go directly or not, the difference is you're getting better service here. So like we talked about, the cost of acquiring the product is the same whether your RIA partners with Colva or works with the carrier directly. The difference is that we'll provide optimal actuarial structures, solutions, and customized feedback that the carrier won't. The other advantages is for fee-only advisors is that you don't need to be insurance licensed. So we help your RIA implement these solutions without the need to be licensed and have anyone on your team licensed, life insurance and annuity licensed, right? So you don't have to worry about that while still being able to, again, charge your fee on the assets, which is a key element, right? You don't want to be having assets taken out of your AUM to invest in these solutions. So again, with the way the industry, the financial advising community is going towards, fee-only advisors, fiduciary advisors. Insurance companies are coming up with better insurance solutions. A lot of them are turning into no commission solutions. We talked about the no commission annuity solutions. There are no commission life insurance solutions. And over time, there will be an increasing trend as life insurance companies don't use high commissioned agents as their distribution channels. They'll be using RIAs. But the issue is now at the infancy where we're at is that RIAs don't understand how to use these products as financial planning tools. So, the benefit of utilizing Colva is that we'll walk you through the full array of products and show you which are high performing, which are low performing, and how which ones can be better structures and which ones can't. And we'll work to show you which are the best solutions. Most of which will be the no commission, but in some cases the commission ones work better, and we can talk about why that is. Again, since we're fiduciary partners and with access to 94% of the carriers in the marketplace, we can provide your clients with the best products and structure that are actuarially optimized for your clients in a way that no one else can. Because other people don't have experience actually pricing it and understanding how these products work the way we do. One of the things we do work with is we understand at this infancy stage, right, using some of these no commission products, particularly the no commission annuity products, can be operationally inefficient at the moment. Again, as more bigger players come into the space like InvestNet and try to streamline a lot of this process, that will kind of go away. It'll be hopefully one day as simple to invest in an annuity straight through your custodian as you invest in other strategies through them. Obviously, right now it's not at that point, but this is an area which we actively help on the operational. How do we make the process seamless for the RIAs, right? Such that we both agree that the math makes sense, but it needs to be operationally efficient as well. So we help RIAs implement them, as they decide that the strategy makes sense for them and their clients. Finally, I wanted to include our website and email information if you want to reach out, if you'd like to learn more about who we are and what we do. Please reach out and we can talk and see if we're a good fit for you and your clients. Anyways, that ends the webinar for today. So thank you for taking your time. I know it's a long time to spend an hour, talking and listening about life insurance, but hopefully you understand the value that it can provide, especially in this low yield environment, and ways to provide better solutions for your clients. Thank you.